Good evening and welcome to Your Retirement and Taxes webinar. My name is Sean Lee. I'm your host for this evening's webinar. I want to make sure that we set some expectations right up front, kind of go through what you're going to see in tonight's webinar and give you an idea of how long we're going to be here. I know that being on a webinar, it can, we could potentially get distracted, phone rings, TV's on, neighbors are going to the door, whatever it may be, but I promise you this, that our time spent this evening will be well worth your while. So what we want to do is let's do a couple of things. Let's close our door, let's mute our phones, and let's prepare to go through 50 minutes of really good content when it comes to your retirement and taxes. This is a really crazy time. It's a time like that we've never experienced before. And what I want to focus on during this webinar is to control what you can control. So control what you can actually control. We can't control what the markets are doing. We can't control what inflation's going to do, or if interest rates are up or down. We can't control any of that. But what we can control is how we plan. And we can control how we create our income plan, and we can control how our tax strategy is built in to our plan. So those are the things that we can control. And so tonight, let's focus on what we can control, not what we can't control. Let's set expectations really, really quickly. It's a little bit different. I can't see you guys, you can see me. But I want to make sure that this is as interactive as possible for you and for us. So on your dashboard, what you can see is that you can see a little questions tab or a raise your hand tab. If questions come up, go ahead and just shoot them in there. I'll be able to see them and I'll be able to answer them in live time as we go through this. Now, if it's a question that's a little bit deeper, that's going to take a little bit longer to answer. That's what we offer. That's why we offer a 15-minute discussion, so we can answer those questions in greater detail. So what will you get from this webinar this evening? You're going to get 50 minutes. I'm going to try to keep it to 50 minutes. I know if we go after that, we're going to lose you. Life's going to happen and we're going to get distracted. So we're really going to try to focus on keeping this to 50 minutes or less. I'll answer questions and go through what I feel is probably the most important topic when it comes to planning. I've got a bunch of different screens here, so I'm going to go back and forth. Now, the other thing that you'll get from this webinar is twofold. Yeah, you're going to go ahead and be able to answer or ask any questions that you want, but in webinars like this, what we find is that there's always more questions than answers. When I teach a class like this, there's always more questions than answers, whether it's in person or online. So what we're going to do is we're going to ask you to do one thing for us since you're attending the webinar. We're going to ask you to fill out a survey at the very end. Tell me how this went. Tell me, was it worth your while? Did we meet expectations? Did we not meet expectations? And how we can do it better. Additionally, what our offer is this evening is that we're going to offer you 15 minutes with one of our trusted advisory team to just answer any questions and really give you some additional insight into what we talked about this evening. Now, as we're going through this, if you feel like, hey, you know what, I want to just jump on that 15-minute discussion, go ahead and just type your name in the questions, and then Corey from our office will call you. I promise, guys, this is going to be well worth your while. I'm excited to do this. I love this topic. This is one of my favorite topics to teach. So let's just go ahead and jump right into it. Now, when we start to talk about taxes, we focus on complete planning at our firm. We focus on income planning. That's the primary foundation, and we'll talk a little bit about that tonight. We'll talk about there's investments. That's another piece to the hub. That's another piece to the puzzle, but investments shouldn't be seen as in a silo. Then we've got the tax plan. And now inside of tax planning, what we're going to discuss tonight are three main topics. We're going to discuss how are your investments taxed? There's all these different things that are out there. How are they taxed? Another question we get that we'll talk about is provisional income. How is Social Security taxed? Now, Sean, that's going to be a part of our retirement. How is Social Security taxed? And then we're going to go through at the very end, which I love, we're going to go through a withdrawal strategy to show you how putting a little bit of thought into your tax plan can make a dramatic difference inside of how your assets are built out. Now, if you've been to one of our events before, you know that this is my favorite topic. I love to start with this. For those that have never attended an event of ours, I'll ask you this. Now, you don't have to answer because I can't see you, but what color is a stop sign? Everybody says, Sean, that's easy. It's red and white. We've been driving for a long time. We understand what color a stop sign is. Come on, let's move along. What color is a yield sign? Now, this is where I start to get various answers. Sean, a yield sign is yellow and black. Well, if you said yellow and black, the yield sign is actually red and white. Now, I love this because immediately when we get asked what color a yield sign is, we go to this. And everybody thinks that. I'm 39 years old. When I was asked this question 8 years ago, this is how long I've been using it. I love this topic. I said yellow and black. The reality of it is the yield sign has not been yellow and black since 1971. Think about that. 49 years, almost 50 years, the yield sign has been red and white. Now, immediately we go to yellow and black, and you may say, Sean, what does this have to do with anything? Well, when we start to look at this idea and this topic, myths and misconceptions from that old world can cause irreparable harm to us in this new world. We could potentially be making decisions that will affect us down the road based on old rules of thinking, old way of thought. You know, if you go back to the 80s, how many of us would have put all of our money into retirement and 401ks and things like that? And don't worry, you're going to be in a lower tax bracket down the road. Well, the one thing that I can't control what the government's going to do to taxes down the road. I can't control that. All I can control is how I plan and how I build my tax strategy. The 4% rule, which was another myth and misconception, or having the 4% rule, which what that means, the old rule of thought was you could pull out 4% of your assets without fear of running out of money. Well, things have changed, the economy's changed, the markets have changed, bond rates have changed. A lot of things have changed. Now, with the 4% rule, studies have come out and said, well, it's now the 2% rule. It's a myth and misconception. Now, so what we want to talk about tonight is, are we building a strategy that is as unique as you are from a tax perspective? Everybody on this webinar is completely different. Your situation is different, and your needs, goals, desires, and values are different. So don't worry about these myths and misconceptions. We want to build a strategy that's based off of facts and logic. Now, what you'll see in your little tab, we have attached some handouts. Before I go into some of this other stuff, we have attached 4 handouts for you. These are yours to download. These are yours to open up. We've attached a 2020 tax sheet. We've attached a downloadable evaluation form that's fillable that you can send back to us. We're sending you a survey, and there will be a survey at the end of this, but if you want to download that, great. We added a required minimum distribution worksheet. Now, if you're getting closer and closer to 70, then you got to figure out, or excuse me, 72, you got to figure out how you're going to, how much you need to pull out, which I'll talk about as well. And then there's the white paper, just some information from us to you. So let's jump into it. Now, the first topic that we're going to talk about is, how is your investment income taxed? Now, and there are four major buckets that, from a tax planning perspective, that we look at. And when we start to look at actual tax planning, it's important to understand how all of these are going to work. See, what you're seeing directly ahead of you, I'm seeing on my left side, which looks like I'm pointing right, and vice versa. But what we're seeing here is that there are 4 tax buckets. There's taxable, there's tax deferred, and there's a tax-free bucket. Now, with that, the 4th bucket is income and estate tax free. I'm not going to spend a lot of time on that, but what I will do is I'll answer questions as they arise. So now these buckets are really pretty. They're really good looking. However, I'm not really interested in using those buckets. What I want to do is make this more interactive for you. So what you should be able to see now is a different screen, which is over here for me. Now, what you're seeing on this particular screen is the starting point of a plan. And what we're going to talk about right up in here, when we start to look at any sort of plan, we want to look at what are my expenses. So this is kind of the mindset of how we start this income process, the math problem behind it. Well, what are my expenses in retirement? What do I need to live on? And we break those out between essential and we break those out to discretionary, right? And the essential expenses, you say, Sean, my expenses are $5,000 per month. I don't know, everybody's number is different, but I'm just going to throw that out there. So that's what I need to live on, and maybe that's going to allow me to do the things that I want to do. I want to travel, I want to golf, you know, I want to enjoy retirement. That's step 1. Step 2 are understanding our sources of income. Right? Understanding where are our incomes going to come from, whether it's, you know, Social Security, whether it's a pension, whatever it may be. But let's say the sources of income are $3,000 a month. Now that's where my income's coming from. Well, now I have an income gap. I have to come up with $2,000 per month from my retirement accounts, from my investments. How am I going to do that? Now here's where the tax planning comes into play. How much are you going to pull and from where? Now, when we look at creating income, there are only 3 ways to do that. And I apologize, I'm a lefty. My handwriting is not great, but hopefully that gives you an idea of what we're trying to accomplish here. Whoa. Now, from an income standpoint, you can create income protected, and you can use various investments there. It doesn't matter from a tax perspective, we can talk about that. But when you start to look at, I need to solve that income gap, that $2,000 a month needs to come from my investments. I need to be able to solve that one of 3 ways, and everybody falls under these lines. Protected is one. I just want my income to be secure. I want it to come in on a consistent basis. I don't want to worry about it. The other side is the market. I want my income to come from the markets. In my opinion, this is just my opinion, I like dividends. I like companies that are paying dividends, and I like companies that are going to provide a consistent revenue stream. Or Sean, you know what? We're not one or the other of these. We want a combo. So we want this income to come in a combination from protected market, whatever it may be. Now, once we know that, then we can come down into the tax side and we can start to look at our buckets. And the idea behind that is that we want to keep our ordinary income as low as possible. We want to control the things that we can control. And in a lot of cases, it comes with tax planning. So our first bucket, if we scroll down, is the taxable bucket. Now what you can see there, it's not a bucket, it's a box, but I couldn't figure out how to put fancy buckets on here. The first area is taxable. And inside the taxable bucket, you have ordinary interest, capital gains, and dividends. So ordinary interest, that's interest that you receive a 1099 on. I receive a 1099 from my investments on an annual basis. It used to be that you'd get a 1099 from your CDs for your bank. But you can also receive a 1099 from after-tax brokerage accounts that maybe have mutual funds in them. Now, ordinary interest, like I said, the goal is to keep this as low as possible. Ordinary interest fills up our bucket, which becomes important with how Social Security is taxed, how Medicare premiums are taxed or increased. There's a lot that we need to focus on with this ordinary income bucket. The next area, capital gains. Now, capital gains come in the form of long-term capital gains and short-term capital gains. Handwriting is a little wonky there, but that's okay. Long-term capital gains are taxed much differently than short-term capital gains. Now, the only difference is that one day, if I hold an investment for 365 days or longer, it becomes a long-term capital gain. Now, here's the thing with capital gains. Capital gains come to us in the form of a sale of what we call a non-inventory asset. So it's a non-inventory asset. Rental property, individual stock. So if I bought a share of, I don't know, Tesla at $100 a share, and then I sold it at $500 a share, and I held it for a year, I would have gains of $400 in that stock. And I would pay long-term capital gains. And what would happen is that my capital gains rates fall right here, right? So I'm paying taxes on the gain, the sale of what's called a non-inventory asset. I do not pay taxes on that asset until I sell it, though. It's important to remember. So if we look at this just really simply, I've got ordinary interest and in form of a 1099, and let's say that I own some mutual funds that are after tax. The mutual funds are a basket of holdings. Or I could own what's called an exchange traded fund. So an ETF trades like a stock, however, it has the diversification of a mutual fund. Now, why is that important? So when we look at just that from a tax perspective, because Vanguard has an S&P 500 mutual fund, they have an S&P 500 exchange traded fund. If we look at that just in a vacuum, just from a tax perspective purely, the mutual fund is less efficient from a tax side than the exchange traded fund. The reason is you don't pay gains on the mutual fund until you sell it because it trades like a stock. So just from a real simple tax perspective, if I had the choice between a mutual fund or an ETF after tax, I want the ETF. And then we've got dividends. Dividends. And there's a lot going on right now. Some companies are cutting back their dividends, some aren't. There's what's called an ordinary dividend and what's called a qualified dividend. So a qualified dividend is taxed differently than an ordinary dividend. Ordinary dividends come up and fill up our tax bucket. You see what I mean? So we're looking at ordinary dividends increasing our tax bucket. Qualified dividends now are taxed much like capital gains. They're taxed much less. They're taxed the same way that capital gains are, long-term capital gains. So it behooves us to buy companies that, if they're going to pay a dividend, that pay a qualified dividend. That's important because it doesn't fill up your tax bucket. We want to keep this as low as possible right in here. Now, once we move on from the tax side, we then move into tax deferred. Tax deferred is, all of our retirement accounts, our IRAs, our 401ks, 403bs, TSPs, anything that we went in and we got a tax deduction, it grew tax deferred and comes out taxable. Now, anytime that we pull money from this pot, this tax deferred pot of money, it's going to be taxed as ordinary income. And the government said, that's great, don't worry about it. Take the tax deduction now, let it grow tax deferred, And don't worry, you're going to be in a lower tax bracket when you retire, when you need that money. Now, the government said, hey, we're going to give you all these benefits, tax deferral, tax deductions right up front, but you have to play by our rules. And this is where some changes have happened. Well, the first rule is 59.5. We know what that means. Sean, I can't touch my money until I'm 59.5. If I do before then, I have to withdraw 10% from that asset pool. Or I'm penalized 10% from whatever I withdraw, excuse me. And then the government can't, this changed. So if you're under 70.5, under 70 going into on January 1st, the Secure Act hit and it changed your required minimum distribution age from 70.5 to 72. However, if you are already in required minimum distribution age, sorry, you have to maintain that structure and strategy. Now, the government has a calculation on how much you have to withdraw each and every year, and which I'll go through. But at 72, if you just said, you know what, I'm not going to take my required minimum distribution. You can't make me take it. I do not need it. The government will penalize you. And that penalty is 50% of the amount that you were supposed to withdraw. So if you were supposed to withdraw $20,000 and you say no, you have to then go in and pay a penalty of $10,000 and pay taxes. And I'll just say 25% in taxes, Fed and state. You have to pay out those taxes as well. And now you get $5,000 in from that $20,000 that you were supposed to pull out. So if you're supposed to take a minimum distribution, make sure that you take it. Now, how is that calculated? Well, the government says December 31st of the previous year is what we are going to make you calculate your minimum distribution off of. And let's say that you've got $1 million, and that calculation, the way that you calculate it, and I'm just using age 72, is if you take the $1 million and you divide it by 25.6. That's the divisor. And in your handout that you have here, that's the divisor that you need to go ahead and calculate that from. So what I'm going to do, let's go ahead and calculate it. Let's go ahead and get this calculation so you can see. Now, we have $1 million and I divide it by 25.6. I have to withdraw $39,062 from my IRAs. You may say, Sean, that's too much. I don't need that much money. In the example above, I only needed $2,000. I only needed $2,000. I don't need $39,000. It's just going to ratchet up my tax rates. Think about this. Every year that you get older, so what if we're 73 now and we have the same $1 million example? Now I divide it by 24.7. Uh-oh. $40,485. Every year that I get older and that divisor goes down means that I have to pull out more and more money. But if we look at tax planning, excuse me, strategically, and we really think about it, we have a phenomenal opportunity. And that phenomenal opportunity is right here from 59.5 to 72. It's a great opportunity. It's an opportunity that we'll never see before. But here's the reason why. It's the only time in history in your life that you will have access to your money, but you're not required to take it. You have access to it, but you're not required to take it. So that's what we call your golden decade. Well, we'll call it your golden 13 years, but that's your golden decade. Your golden decade allows you to make choices. It allows you to determine, how am I going to incorporate Social Security? How am I going to withdraw assets from my plan? If my required minimum distribution is going to be too much, how do I lower that? this is the period of time where you have that opportunity to do so. So you have choice here. And this is where tax planning comes into play. Now, if you're over 70 and a half and you're taking minimum distributions or over 72, it's no big deal. We just plan differently. There are different choices and options out there that you can incorporate to reduce taxation, whether it's qualified charitable distributions, things like that. The third bucket is your tax-free bucket. Now, Sean, how do we get money from here to here? Well, you pay the tax. And that's what's called a Roth conversion. Now, I won't spend a lot of time on Roth conversions, but a Roth conversion is the idea of I'm taking money from this pot and I'm moving it over to there, and I'm paying the taxes on it to get it into a more tax efficient situation. Now, I don't know if that works for any of you or all of you, but that takes some thought. Moving money from one pot to another takes some thought and some strategy on determining what will that do to me short term from a tax perspective, and what will it do to me long term from a tax perspective. And on the flip side of that, how do we get assets to our next generation? So the tax-free bucket is post-tax. You've already paid taxes on it. It still grows tax deferred and comes out tax-free. The three areas there are Roth IRAs, Roth 401k, and cash value life insurance. Now, I'm not making a recommendation to go out and do big Roth conversions. What I am going to say is think strategically about, should I potentially do a Roth conversion, and how will that affect me short and long term? I said that's something that we can talk about in a 15-minute call with you if that's a concern or if that's a question for you. But we have to look at all three of these buckets strategically, right? We have to look at all of our assets strategically, and how are we going to control what we can control? And what we can control is how we're going to generate income and how we're going to handle our tax return. We can control those. I can't control what the market's going to do, but I can control how my plan is built and how your plan is built from an income and tax perspective. That's important, and I'll talk to you about why. Now, let's go in and let's go back to Social Security. Now, I've gone really quick and fast and hard. Are there any questions that are going to pop up? If there are, just raise a hand, and I'll give you a little bit of time to type that in. Otherwise, I'll just continue on down this road, and I'll feed you with a fire hose of information, and then we'll get some clarity as we go through and discuss things one-on-one. Okay. All right. Let's rock and roll. Let's keep going, guys. I've got 20 more minutes to keep your attention. I can't see you, so hopefully I'm doing it. But let's talk about Social Security and provisional income now. Social Security and provisional income is a big deal. There's a lot of financial noise around Social Security and provisional income. You know, and I'm sure that you're hearing it all over the place marketing wise, and there's a lot of fear marketing going on right now. But, you know, if your tax plan isn't built right, you'll pay up to 85% in taxes on your Social Security, or 85% of your Social Security will be taxed. That's financial marketing. What I want to talk about is financial science, the mathematics behind how Social Security is taxed, okay? So if we're looking at our screen that's showing Social Security and provisional income, let's talk about what that means. Well, what is provisional income? Provisional income is just the income the IRS tracks to determine if your Social Security is going to be taxed or not. That's it. That's all provisional income is. It's the income that the IRS tracks to determine if it's going to be taxed. So what are those thresholds? And this is where the financial marketing comes in. Oh, if you're married and you make over $44,000, up to 85% of your Social Security is going to be taxed. That doesn't mean that if you make $44,001, that your Social Security is going to be taxed up to 85%. It's skewed, much like it's a graduated scale, much like your tax rates. Okay, So don't let it scare you. Understand the math and logic behind it and how it works. So what counts? Basically everything. All earned income, all distributions from retirement accounts, all pensions, all rental income, 1099s from your taxable bucket, interest from municipal bonds, and then 1/2 of your Social Security. What doesn't count? What doesn't count towards your provisional income? The tax-free bucket. Roth IRA, Roth 401k, cash value life insurance. Now, I'm not saying go out and get a whole bunch of Roth and can do a lot of conversions and buy life insurance, do all that, but that doesn't count here. So how does the calculation work? How does it work, Sean? Well, what the government does is they take all of your gross income, and I'm just using an example here, and we're saying it's 32,184, right? And as a household, they're getting 40,596 in Social Security. So this household, as an example, is bringing in $6,000 per month. Not bad. It's a great living. That should cover needs. That should cover everything that you need, right? So here's where the calculation starts. Gross income, 32,184. Social Security income is 20,298, which means, so that 20,298, stay with me, is half of the 40,000. So remember, they use half of your Social Security to calculate how much of your Social Security is going to be taxed. So you add 32,184 plus 20,298. That gives you $52,482. That's the amount that they use to calculate how much of your Social Security is going to be taxed. So you're at 52,482. Oops. First 32, remember I said it was graded up? The first 32, let me go back to that. It's graded up if we're married filing jointly. I'm just using that as an example. Below 32,000, 0, 32 to 44, 50, above 44, 85. So how's that calculation work? Well, 0 to 32,000, there's no calculation there. There's nothing from a tax perspective. 32 to 44, it's 50%, so that's $6,000, right? And then above the $44,000 of income, so 52,482 minus 44 is $8,482. So you multiply that by 85%, which gives you $7,210. So the taxable Social Security is $13,210. Even though your income was over the 44, the calculation doesn't say you're going to have 85% of your Social Security be seen as taxable income. Only $13,210 of Social Security is going to be seen as taxable income. So here's where it gets fun. And this is where we start to look at the math behind tax planning. Because there's a lot of, oh my gosh, Sean, if only $13,210 of my Social Security is taxed, what is that going to do to me from a tax perspective? Well, if your gross income was $32,184 and your taxable Social Security was $13,210, your taxable income is $45,394. That's your taxable income. That's the income that you're going to be taxed on. So here's the deal. When we look at that, let's take it a step further and look at tax planning strategies. Well, if I look at my tax return, and my tax return is going to give me let's say a $24,000 standard deduction, If I'm over 65 and my spouse is over 65, I have a standard deduction of an exemption of 26,600. But let's say that we're 63. Now my taxable income is 21,394. The majority of that's going to fall in the 10% tax bracket. So let's say that it's 11%, just to keep math easy. I'm going to pay taxes on about $2,300, let's say. So here's where the calculations get fun. Remember, in that example, I made, we'll just say $72,000 between withdrawals from retirement accounts and other investments and pensions. My Social Security was 40, so I had $72,000 in pocket. My taxes were $2,300. If you divide that out, that's a little bit over 3.2% tax rate. I'll take that all day long, right? I'll take that all day long. Because what I want is I want tax rates as low as possible so I maintain control if the government changes tax law down the road. I want to maintain control if I choose to do some Roth conversions, things like that. So don't let Social Security and provisional income scare you. It just takes some mathematics, it takes some thought, it takes some time and energy and effort. Remember, the thing that you can control is how you plan. And we can talk about this on, on the 15-minute call that our team does with you as well. So let's roll back into our last topic. So I said today we're going to talk about withdrawal strategies, how things are taxed. We're going to talk about how Social Security is taxed, how investments are taxed, and this to me is the most important part. So if you're thinking of jumping off early, don't jump off early. This is the withdrawal strategy and why it matters is extremely important. It's extremely important because putting in some thought into your plan will make or break your plan. You'll have a dramatic effect, I'll at least say that. So let's look at conventional wisdom. And we talked about the three buckets before: taxable, tax deferred, and tax free. And conventional wisdom tells you, and this is how a lot of firms teach advisors to do withdrawal strategies, take money out of your accounts sequentially. So pull out of your tax accounts first, then hit your tax deferred accounts, then withdraw from your Roth accounts. The reason that they teach that is that they want you to let the IRA compound. Don't worry, it's a classic approach. You're going to be in a lower tax bracket down the road. Once you get to age 72, it's fine. You'll be all right. But what if it's not? What if you let your IRA continue to compound and it gets to a scenario where you have to pull out $100,000 from your investments? Well, you're in the government strategy at that point. You have no control. So what we look at when we start to look at tax planning and withdrawal strategies, we said, let's do this. Let's think about this strategically. Let's not follow the norm, and let's put a case study in. So what I did is I ran a case study, and this works whether you're married filing jointly or a single tax filing. But what I did is I looked at a case study, and this is Jim and Joan. They're 66 and 65. They've saved $680,000 for retirement. You see it in different buckets. So they've got some 401k money, they've got some taxable money, which is after tax, and then they've got some Roth money. And they plan to retire in a year. Now the other things that I did, so I did use some assumptions. So to be completely transparent, the assumptions that I assumed is that they need $30,000 per year from that $679,000. They need $30,000 in their pocket. They need that to live on. That was their income problem. That was their gap. I used 3% inflation. 3% inflation rate, which right now is high. 2007, 2008, it was low. So I'm just 100-year average shows inflation at 3%. And then I also used a 6% rate of return. not light the world on fire, 10%, 12%, but I used a 6% rate of return. So I used 30% in pocket, cash to live on, 6% rate of return, 3% inflation rate. Here's what we found. If you use conventional wisdom, and if they use conventional wisdom, which meant that they pulled money out of their taxable bucket first, tax deferred account second, tax-free accounts third, they had a 68% probability of success to live to 93. Now what this is, we ran a Monte Carlo simulation, and what that does, it runs 1,000 different scenarios based on different markets and things like that, and gives us a probability of success. You say, Sean, I'm not going to make it to 60 or till 93. Okay, I'm only going to make it to 88. So we backtrack 92, 91, 90, 89, 88. Well, you have $380,000 to give to beneficiaries. Not bad. That's good. You know, money passed on, and you lived, and there was still money left over. But that wasn't quite good enough for me. So what I did is I said, well, let's think a little bit differently, and let's go unconventionally. Unconventional wisdom says, I'm not going to pull money out sequentially or from my taxable bucket first, my tax deferred second, my tax free third. I'm going to flip it. I'm going to go in reverse, and I'm going to pull money out of the Roth IRA first, which we'd never do. From a tax perspective, it doesn't make any sense. But I wanted to see what it looked like, to see if maybe conventional wisdom was right or wrong. So all that I did in scenario B was I flipped it. I said, have money come out of the Roth IRA first, the traditional IRA second, and the taxable bucket third. That's all I did. I just flipped it. Now, looked like it's a bad idea. 0% probability of success to make it to age 93. 0. Sean, I'm not going to make it to 93. Okay. 92, 91, 90, 89, 88. You have less money in this strategy than you would have otherwise. It's $80,000 worse for you. But if we really start to think about this strategically, we knew that the conventional wisdom was better. It wasn't good enough for me. I wanted to take it one step further, and I said, what if we actually just put some thought into this? What if we used all the different buckets of money that we have available to us, and we said, all right, let's put a real plan in place. And let's not follow the norm. Let's not follow conventional wisdom. Let's build a plan based on what your needs are and what the plan needed, and really think strategically from a withdrawal perspective. So what we did is we cheated a little bit. And what I mean by that is we just put some thought into the plan, and sequential withdrawals weren't good enough. We withdrew assets simultaneously. Now what I did here, I kept all the assumptions the same. $30,000 need in pocket, 6% rate of return, 3% inflation. However, here's the big difference. We didn't sequentially pull money out. What we did was we simultaneously pulled assets out. So we used the 401k right up front. We didn't wait. We withdrew money from the taxable account as well. And we pulled money out of the Roth account at the same time. So we used all three accounts all at the same time to create the income for this plan. And it had a dramatic effect. There wasn't any smoke and mirrors. There wasn't anything fancy. What it was, we used investments simultaneously rather than sequentially. Because if you're going sequentially in that middle pot, which is the IRA, in order to get $30,000 per year, you're going to be taxed. So now you have to pull out maybe $37,000 to $40,000 per year. That's where the compression on the plan happened. So we used it simultaneously, and now it added a significant value, 100% probability of success. I'm not going to live to 93. Okay, let's go back to 88. And rather than having $380,000 or $400,000, now just by putting some thought into your plan, you doubled the inheritance. You doubled what you passed on, and your lifestyle did not did not have to change. You lived, you enjoyed what you were doing, but you took the time up front to devise a tax strategy, a clearly defined tax plan. You put that in harmony with an income plan, has a dramatic effect on the overall effect of your portfolio. Now, you can see scenario comparison. I don't know about you, but I kind of like the third comparison. And here's the thing about it. If you look at the far right, they actually withdrew more income. Not by a lot, but the withdrawal rates were a little bit higher. So put more money in their pocket. Here's the deal, guys. When we start to look at complete planning and we start to look at building a strategy that is unique as you are, planning takes time, but control what you can control. So when you start to look at this and you look on a screen, holy cow, Sean, there are 5 areas of planning that I have to focus on. The hardest part is just taking that step to talk to somebody and walking through a process to build the plan that you desire and you deserve. Because there's a lot of noise out there. There's a lot of marketing, financial marketing, and there's a lot of kind of scary stuff that's out in the marketplace right now. But it doesn't have to be. It just takes time, energy, and effort, and you can get the plans that you deserve. Now, I told you at the very beginning of this, I'd try to keep it to 50 minutes, 1 minute early. 6:49, I barely made it. However, all that I ask from you in this is that you give me some feedback. I love teaching. I love doing these, and we ask that you stick on the webinar and do the survey that is going to pop up on your screen. If you feel like, holy cow, Sean, you blew us away. I have more questions than answers. Take us up on that 15-minute call offer. Here's the worst that happens. The worst that happens, you find out you're in good shape. And you spent 15 minutes of your day to determine that you're in good shape. But what about the best thing that could happen? The best thing that could happen is that you find some gaps and you're taken through the process to build a plan that you deserve, that's going to allow for you to sleep well at night, be confident in your overall structure and strategy, and start to take the emotion out of it. That's the best that happens. Worst that happens, 15 minutes of your day. The best that happens could be life-altering and life-changing. That's all that I ask of you. Please give us some feedback. I appreciate everybody that was on this call as well. As you can see, I really enjoy doing these webinars, doing teaching classes, whatever it may be. Thank you, and have a great night. All the best.